What's up everyone, it's Scotty with MoneyVest. So this is going to be a very, very important video for all of you because I'm going to break down the one most important economic marker to pay attention to as we're starting to see some shifts in the economy. So I'm going to break down very data-driven analysis. We're going to take a look at this spreadsheet. I'm going to break down every single metric and what that means for the economy moving forward. We're going to talk a little bit about unemployment, wages, and inflation. So hope you guys enjoy it and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. And of course, link to our Discord and Patreon is going to be down below if you'd like to support the channel, if you'd like to support my work, if you want to join our MoneyVest community, get access to all the buy and sell alerts, options alerts, trade ideas, our members only private videos, our intrinsic value spreadsheets, our research reports, everything is going to be included with the link down below, and we'd love to have you on board. So this right here is a spreadsheet that I am going to come back to, which is very, very important. I've kind of talked about it in briefly here in our previous videos. I'm going to go into a lot of detail and why this is such an important metric. And unemployment is the make it or break it economic indicator for any economy, right? Because unemployment is what really dictates the level of productivity in any economy, the level of spending, the level of investments. Everything is dictated by unemployment. And I'll get to that in just a minute. But this right here is basically the JOLTS numbers. Actually, you know what? Let's just start here. So the reason why this is so important is because we know the Federal Reserve has been raising interest rates, right? They've gone up over 500 basis points in the last 12, 16 months. They're planning to maybe raise another 25 basis points in the next couple meetings here before the end of this year. And they're going to keep rates higher for longer in order to bring inflation down. That's the goal, right? Inflation's running way too high. Core sitting at 4.7, core PCE sitting at 4.2. Headline obviously lower because energy prices are lower, but core inflation is what they're focusing on. And it is where it is, right? It's way above the Fed's target. So they've been raising interest rates. Now, never in the history of raising interest rates, this data goes back to as far as 1954, that raising interest rates did not lead to a rise in unemployment. So if you basically go back and check some of the data points here, so I'm going to point out to this time period where interest rates were going higher, right? So if you go back, we basically were 2.5 to, it was around 2.75%, 1958, unemployment eventually did spike. This right here, once again, interest rates were lowered during a recession. So this right here, the gray areas are basically recessions. So recession, interest rates lowered down to near 0%. Once again, the Federal Reserve starts hiking them. Once again, to basically make interest rates go higher, cost of borrowing needs to go up. Guess what happens? Unemployment, once again, spikes, goes into a recession. The economy does. This right here, once again, a very similar situation where interest rates go higher. The blue line is the interest rates, and then eventually what happens? Well, unemployment follows. This right here, once again, interest rates go higher. What follows is unemployment obviously starts going up. That's the red line. This right here, 1980s, 1970s, great inflation during that time. Unemployment also goes up because we go into a double dip recession in 1980s and 1982. Unemployment also spikes both of those times when interest rates are higher because that's what breaks the economy, is higher interest rates. If you come over to more recent times, very similar situation every single time. As you can see, going back, there is a little bit of a lag effect with certain things, right? So there's definitely a lag. So you'll never see both of these kind of perfectly on top of each other. One happens before, one other one happens after, or vice versa, depending on the situation, depending on the market circumstances, the economy, the time period. But bottom line is, eventually it does. Interest rates go higher here and unemployment follows. Interest rates go higher here, unemployment basically follows, right? Interest rates go higher here, unemployment follows. So bottom line is, when interest rates go up, unemployment follows. Now the interesting thing is that we haven't quite seen that yet. Interest rates are higher, unemployment has not followed, right? The red line is still low. It is still at near 3.5, 3.7, 3.8%. And part of that reasoning is because there was a lot of excess income. There was a lot of excess savings. So the savings rate did spike up to over 60, 70%, levels that we've never really seen. And now, of course, since it's back down to 4 to 5%, so people are not really saving as much money anymore because during the pandemic, of course, everyone was working from home. Everyone was literally at home. So we weren't spending as much, and we were given checks, stimulus checks, by the fiscal government, of course, giving a lot of money, and, excess savings were really, really high. Now, there's been a lot of shift in the consumption as well. Earlier, it was mostly goods. Now it's been moved more towards services. And the service industry and just the overall economy continues to be very strong in a sense that if people are employed, they're able to take on more debt and they're able to spend more. And as a result, we are able to see companies report very strong earnings and they're able to continue to hire. So it's a whole process, right? There's a chronological process that goes with this, is that if you've got very strong consumer, you will have strong earnings and you will have a strong labor market. Now, speaking to that point, if you come over to where the job openings are, this is a leading indicator. Unemployment obviously is a leading indicator, but underneath unemployment, more specifically, it's the job openings. Because job openings is what really tells us businesses and are they really hiring or not? Are there job openings for people? And what you will notice is that every time this starts to decline, and this actually only goes back as far as 2000, so we don't have a lot of data, but every time JOLTS, which is the job openings, starts to go down, unemployment starts to creep up. And again, you can see JOLTS going down here, unemployment starts to creep up. Again, this is not scaled well, so you may not be able to see like a big significant increase. You might be wondering like that's not big of an increase. It's not scaled properly. So, but that is a pretty sizable increase in level of unemployment. This right here is the decline in the JOLTS. This is the increase in unemployment. This is the decrease in JOLTS. This is the increase in unemployment. And well, guess what the trend looks like now is JOLTS is trending lower. We in fact just printed at sub 9 million job openings in the US, and it is now coming down. But yet, unemployment stays flat. Unemployment is not going higher. So now there's a lot of reasons. There's both reasons for and against as to why this labor market's so strong. But it's now starting to show some cracks. And I don't want to get into the reasons as to why it is so strong because we've already covered those. And I'm sure from a macroeconomic perspective, there's just so many variables that are suggesting the labor market to be so tight. But I'm here to kind of guide you in the right direction in understanding that there are some indicators that are now showing signs of some cracks in the actual labor market. And that is your unemployment persons to JOLTS ratio. And this is something that we have talked about in one of our previous videos as well, which is basically taking into account the JOLTS, which has come down, as I showed you guys, the green line, the green chart, which is trending lower, and the unemployed persons, which is the people, the number of people that are actually unemployed in the US is ticking higher and higher. So as that number reaches an equilibrium, which is going to be this chart right here, that's job openings divided by unemployment level. And again, you can go back as far as 2000s. This is the first time in the last 23 years. Actually, I should say the second time in the last 23 years that the green line is above the blue line, meaning that there are more job openings than there are people available to work. So there is a significant imbalance between the supply and demand of labor. And when that happens, it's more favorable as being a worker to demand higher wages because companies can't even find people to work for their positions because right now there's more jobs than unemployed people. So there's over 8.8 million job openings for every 6.3 million unemployed person. So that ratio is at 1.39, meaning there's for every one person in the US, there's almost 1.5 jobs available. And this number has been coming down. It's come down from 2. It's actually come down from 2.5 down to 2 and now sitting at 1.39. So it's an important metric because every time job openings start to come down, as you can see that they have come down here, they have come down here, unemployed persons, which is a good level, which is a good measure of unemployment rate eventually, starts to go higher. You can see that here, you can see that here. And right now, we're yet to get to equilibrium. We're not there yet. And this is when wages come down and keeps inflation low. That's how during a recession, right? During a recession, why inflation comes down is because workers are looking for jobs and there are fewer jobs, right? There are fewer jobs. So basically there's a supply, there's a surplus of workers and there's less jobs. So businesses can pay really, really low prices to hire these desperate workers during a recession. And as a result, wages are down and as a result, inflation's down. But right now, we're in a very interesting situation where there are more jobs than there are workers. And that's why wages are pretty high. They're going higher. Average hourly earnings, consistently keeps going up month over month because there's fewer workers than there are jobs available. But in my opinion, as soon as it starts to hit an equilibrium, when we get down to 1, which is going to be an equilibrium level where there's just as many jobs as there are workers, but then eventually if it starts to flip, is when we start to see some problems happen. And the reason for that is if unemployment starts to go up. It's a chain process. Once again, we covered that earlier in the video. If there's this number right here, unemployed persons starts to go up to, let's say, 8 million or 10 million, right? Then this ratio drops below 1. And now you've got a problem on your hands because that's a pretty sizable unemployed person level, which will raise the unemployment rate, which will most certainly create an economic recession and hurt the earnings of S&P 500 companies in the future, which obviously leads into the overall risk analysis of the market, and not to mention the earnings compression, the multiple compression, and a potential correction. But we're not there yet, so I just want to take it step by step. And this right here is another thing that I want to mention, right? What you will notice on this chart is the level of increase. In order for us to keep the unemployment rate where it is at steady at 3.8%, which by the way has been increased from 3.6, there needs to be a significant increase in the participating population, meaning there need to be more people participating in the economy for employment. Right now, there's not. As we talked about, there's fewer workers than there are job openings. Now, if unemployed persons starts to creep up here because of these higher interest rates, as I mentioned earlier, with every time the rates go up, unemployed persons do go up, right? It's a time lag issue, right? It almost always happens the last 1950s, 74 years. We've tracked the data. It's happened with a time lag. So if this number, let's say, goes up to like 8 or 9 million, right? So let's say 8 million, because the Federal Reserve, let me tell you, they have penciled that in. They have talked about this, right? So unemployment rate, they're expecting at 4.5%. So 4.5% is what they're expecting in 2024. And right now we're sitting at 3.8, right? So this is where we are. In order to get to 4.5%, this number would need to get up to 7.5, right? 7.5. So 7.5 million people would need to be unemployed in order for this unemployment rate to be 4.5%. Now, the only way to keep unemployment rate at where it is right now and also have unemployed persons go up to 7.5 is by increasing the participating population. And this would need to increase by a whopping 58 million people, right? So 166.5 plus 58 is what we need to do. So if I hit enter now, that's how you keep 3.3% unemployment rate, meaning that we need to see an influx of almost 60 million people in participating population in order to keep unemployment rate low. If this higher interest rate leads to just 1.5 million people to be unemployed. Hope that makes sense, because the degree of changes here are pretty drastic. And that's exactly why I wanted to do this on a spreadsheet to better help you understand why unemployed persons is the key to unemployment rate. JOLTS is the key to having an understanding of where the economy is going, because everything is driven by unemployed people, right? People, just in people. Like labor market is what drives everything. Spending, investing, saving, inflation, wages. That demand supply is what really dictates everything. And the labor market, again, is the kind of like the key ingredient to kickstarting a boom or a bust. Okay. And right now we're very strong right now, but in my opinion, I think it's only a matter of time before we start to see some moves, upwards moves in unemployment persons. Right now, 6.36%. So it did tick higher from a little bit under 6 million to now over 6 million. But eventually this ratio is going to, in my opinion, come down closer to 1. And that's going to be this line over here. Now, how's that going to play into the economy, you might ask, right? How's that going to play into the markets, you might ask? Now, this, on a surface, yes, from an economic standpoint, may be a negative catalyst, right? Because nobody wants to see a recession. Nobody wants to see unemployment rate go up, right? Nobody wants unemployed persons in an economy because productivity is going to drop. So nobody wants to see 7.5 million people unemployed a year from now when unemployment rate's at 4.5%. And we don't even know if that's where the stopping point is going to be. It's possibly go to 8 million or 9 million or even 10 million and the unemployment rate jumps up to 5, 6, 7%. Now, even though that might actually be negative for the economy, I'm not so sure if that's going to be negative for the market, because markets, again, very forward looking, right? And the one thing that comes with this recession is what? Which I didn't cover in the earlier charts, was the fact that once unemployment rate does go up, what happens after is rates get cut, and they get cut pretty dramatically, right? Every single time. You can see rates getting cut here, rates eventually getting cut down to 0% here, rates eventually getting cut down to 0% here. So it's like a cycle where the Federal Reserve raises rates, breaks the economy, unemployment goes up, and then recession happens, and the Federal Reserve starts to cut rates again. And of course, the markets move in that sort of pattern where they consistently go up. Long term, they're still going up. It's just we see those dips and those corrections and those bear markets along the way. So in my opinion, over the next 3 to 6 months, right, if the unemployment situation continues to worsen, which we will keep track of with JOLTS and unemployed persons, if that continues to worsen, I do think there is a possibility. Again, I'm not saying that's actually going to take place because I'm not making a prediction here, but there is a possibility that we go to a time period where there is high levels of unemployment, there is a recession, which I know has been postponed and pushed back so many times already. There is a recession, which leads to maybe multiples compressing, markets coming down, which will give us the opportunity to dollar cost average and buy some of our favorite stocks at the fair values or even undervalued levels. And eventually, when the rate cuts do happen, we're going to be ready to take advantage of that reversal. So that is going to be that game plan. And like I said, the markets right now, I would say about 15 to 20% more expensive than where I would like them to be. So I'm not like aggressively dollar cost averaging, but I will be looking at individual stocks and undervalued levels and fair values to take advantage of those opportunities, in the future. So that's where we are. Hope you guys enjoyed this video. Wanted to do a little bit of a tutorial, educational / going over some updates on the unemployment numbers and also breaking down some spreadsheets for you guys. So hope you enjoyed it, found it helpful. Make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.